Okay, thank you. Okay. Hi, everyone, and thank you so much for being here tonight. My name is Caroline Park, and I am a realtor with Caroline Park Properties at Keller Williams, Encino, Sherman Oaks. I work with buyers and sellers throughout Los Angeles, and a big part of my work is helping people understand what is actually possible when it comes to home ownership in this market. I know buying a home in Los Angeles can feel intimidating. Prices are high, interest rates move around, and there's a lot of conflicting information out there. But what many people don't realize is that there are programs and financing strategies that can significantly change what the path to ownership looks like. That's really why we wanted to host this session. Tonight is meant to be educational and practical. We're going to walk through some of the programs that exist specifically to help buyers bridge the gap to home ownership, including down payment assistance programs that can provide substantial funds toward a purchase. One program in particular, Dream for All, has actually opened its application window and closes already March 16th. So timing is important for anyone who may want to explore that option. We'll also touch upon a couple of other programs that may help buyers reduce the upfront cash required to purchase a home. So the goal tonight is not to pressure anyone into doing something immediately, rather to give you the information you need to understand what programs exist, who they are designed for, and what steps you would take if you decide to explore them further. When clients come to me, one of the first things we do is build a clear picture of what their buying power actually looks like. Because once you understand the financing side, the home search becomes much more strategic and much less overwhelming. That's why I'm really glad to be hosting this with Chandler Robbins from Premier Plus Lending. Chandler is the expert when it comes to the lending side of the process. He works with buyers every day to structure loans and help them understand their options. And he's going to walk you through how these programs actually work, who qualifies, and what the process looks like. So with that, I'm going to hand it over to Chandler to get us started. Chandler, take it away.
Thank you, Caroline. I'm going to share my screen here for a little presentation that I have. So I'm Chandler Robbins. I'm a mortgage lender located in Sherman Oaks at Premier Plus Lending. We are a boutique lending operation, small company, and we provide great service to our clients. Down payment assistance, there are many down payment assistance programs in the state of California. We're going to go through a few of them here that I've outlined in the presentation. So getting right to it, we're going to cover a few different programs. We're going to cover the Dream for All program, which is by far the largest amount of down payment assistance that you can get out of any program. The funds are limited, the space is limited. Now, there are also other down payment assistance programs that are available all the time. They're not limited in the amount of funds, and can be more forgiving in terms of how you qualify for them. So CalHFA is California Housing Finance Authority. So the CalHFA has several different down payment assistance programs available. And then there's also more flexible down payment assistance programs that don't necessarily have income limits. They have much more forgiving credit score limitations. So we'll go over a few of those as well. The Dream for All program, so this is a state program. It has been run for several years now. When it first came out, it was a first come, first serve basis. So when the applications opened, it was like this mad rush to get in. Now they've changed that to where it's a lottery-based system. You put your name in, and then a couple months from now, we will hear if you've been accepted into the program. So you're going to get up to 20% of the purchase price of the home, up to $150,000. This is a shared appreciation loan. So what does that mean? That means if there's no interest and there's no payments, you take 20% from the state, and then you will need to share in the appreciation of your home. We'll get into that in an example in a little bit. So there's 150 million to 200 million available for 2026. That is going to serve thousands of people. That's going to serve, probably given an average loan size of $600,000, It's probably going to service 3,000 to 5,000 people, families. So there's generally going to be somewhere in the ballpark of 20 to 30,000 applicants. So overall, this is a chance to receive this program. It's around 10%. I mean, there's no specific number, but it's not like we apply and then we're for sure going to get it. There's a relatively low chance of getting it, but it's worth trying. So to be eligible for this program, all of the applicants must be first-time home buyers. There are other programs that we'll talk about later in the presentation that have no first-time home buyer requirement, but for this one specifically, all the borrowers must be first-time home buyers, and at least one must be a first-generation home buyer, which means someone on this mortgage application needs to have parents that do not own a home in the United States. They cannot physically own one right now. If they sold it 5 days ago, that's fine, but they cannot physically own. At least one person must be a California resident, so you cannot use this for relocation unless one particular person on the application is already a California resident. There are income limits for this program. So if you make more than 168,000, then you make too much for this program. Now, there are certain examples in which we can still qualify. I'll give you one example. I can become creative with the way I structure your application. So if you make 160,000 and you make 30,000 of bonus, then I'm not going to include your bonus on your application, which will then allow us, even though you do make more than $168,000, we can structure it so that we can exclude some income to get you under the limit. You have to have a 660 credit score to qualify for this program. There are other programs available that don't have a restriction on credit score. So it's a random lottery selection. Like I had mentioned before, you're going to put your name into the hat, and then they're going to pick names. That process is going to take a couple months, right? So we're not going to hear back right away. The process in more depth, you would talk to a lender, a Cal HFA approved lender like me. I would give you a letter, a specific letter that you need to take with you and upload to the California Housing Finance Authority website. So when we work together, I'm going to give you a link to create an account on the California website. You're going to take a document that I provide to you, and you're going to upload that document along with completing an application on the California website. Let's talk about the repayment of this loan, because this is not a grant, this is a loan. So if you were to take, if you were to look at a $500,000 property, you could buy that property and you would get 20% assistance from the state of California. 20% on a $500,000 purchase is $100,000. So you would get $100,000 second loan. Second loan means you're going to have one loan for the amount that you're borrowing, which is a $400,000 loan. And then you're getting a second loan from the state of California with no interest and no payments. Now, down the line, say 5 years, 10 years from now, whatever works for you, you decide you want to sell that house. And in this example, I'm going to say you sell that house for $600,000. So you bought the property for $500,000 and you took a $100,000 second loan from the state of California using the Dream for All program. You sell it for $600,000. So your profit on that place is $100,000. You bought it for $500,000. You're selling it for $600,000. So you profited, or your equity increased. It appreciated in value by $100,000. So you're going to owe the original $100,000 that you borrowed because you bought it for $500,000. You got a first loan of $400,000. You got a second loan of $100,000 from the state. So you're going to owe the $100,000 that you borrowed from the state. And then you're going to owe 20% of the appreciation of your home's value. Your home appreciated in value by $100,000. You bought it for $5,000, you sold it for $6,000. So you're going to owe the original $100,000 plus $20,000 in appreciation and shared appreciation to the state. So you would owe $120,000 back after the certain amount of time you live there, 5 years, 10 years, whatever the amount of time is. And if you have further questions on this, I'm happy to walk you through many other examples on a separate call. So the regular down payment assistance programs, these are available all the time, right? So there's no specific time frame that you have to put in an application. They're always available. So these are smaller down payment assistance programs. They're not going to give you 100 grand or 20% of the purchase price. You can get FHA down payment assistance and you can get conventional down payment assistance. So the difference between those, FHA, you're going to get 3.5% of the purchase price as a second loan. You're going to get, that's the down payment assistance, right? So normally on an FHA loan, you'd have to put 3.5% down of your own money. In this case, you're able to utilize 3.5% of the state's money and use that as your down payment. This is a down payment assistance loan. So you would have to pay that 3.5% back in similar circumstances to the original California Dream for All, right? So you're going to, if you sell that house, if you refinance that house, you're going to owe the 3.5% back that you borrowed. Same thing with the conventional loan, you would get 3%. So if you bought a house for $500,000, then you would get $15,000 from the state as down payment assistance loan. These are zero interest and deferred payment. So that means there's no interest on the money that you're borrowing, and you don't have to make any payments on the money you're borrowing. You will have to pay it back if you refinance the house or if you sell the house. They're with the Cal HFA regular down payment assistance programs. These are the ones we're talking about. Generally, there are higher fees to get those kinds of loans. So overall, great programs. There are situations in which you can purchase a house with literally zero of your own dollars out of pocket, but we would have to work in stuff called seller credits, which we can also get into on another call. But the $0 out of pocket is feasible. It's possible. I've done it before. Okay, so here's an example. Here's a little bit more details. These are an example. Oh yes, so income and credit score requirements for the regular California HFA down payment assistance programs. The Dream for All program had an income limitation in LA County of 168. If you make more than 168,000, you're not going to qualify. The regular down payment assistance programs that are always available, they have more forgiving income limits. So for LA County, you could go up to $211,000 in total income. Now, the credit score requirement is tougher here than it is on the Dream for All. So what I'll do is take a look at your application and determine which bucket you fall in, right? Now, there are other programs available that have way less requirements, right? So the down payment assistance programs that we utilize through a company called Rise, they have very similar options to California HFA. They're only FHA, so you're going to get 3.5% down payment assistance from these programs. They have zero interest rate deferred payment options as well. But the important part about these, there's no income limits. You can make as much as physically possible, and you will still get down payment assistance. And they also don't have a first-time home buyer requirement. So you can't currently own another home. No. So if you bought a house 5 years ago and you sold it, it doesn't matter. You don't need to be a first-time home buyer in order to qualify for these programs. So there are several different programs within this company that we use called Rise. There's one with a forgivable loan option. So that one has, basically, if you live in the house for 3 years, then the loan is completely forgiven. You borrowed 3.5% from the company, and then the loan is completely forgiven after 3 years. The minimum credit score for these kinds of programs is 600. So it's way more forgiving for people who really need that down payment assistance and are being stopped by a lower credit score for right now. Now, with these kinds of programs, it is more customary to see higher interest rates for those kinds of loans. However, you don't have to pay as much fees. So if we look back to the California options, those ones, they have lower rates, but they have higher fees. So these ones are much more beneficial when we're actually working on getting you into a house, because if you want $0 out of pocket, you want to avoid as many fees as possible. That makes it much easier for you to keep your closing costs down so that you can actually have as little out of pocket as possible. These are only for purchases, obviously, and primary residences only. So we can't do this for single family homes. It's not possible for multifamily homes. So like 2 units, 3 units, 4 units cannot do these kinds of programs. It's for your starter, first time, house or condo. So differences, just to kind of start to wrap it up. The Dream for All loan, lottery system, it's not guaranteed. Your chances are relatively low in comparison to the other options. The California options, there's income limits that are restrictive. There's credit score limitations that are restrictive. They have fees that other loans don't have. The Rise options, no income limits, way lower minimum credit score requirements, and way less fees. And then every person's going to qualify for something different. So the purpose of this is so that you can have some education, but a loan officer who's well versed in these programs is going to be able to guide you to the correct program for you. Down payment assistance programs in general, I would say if you can make a down payment, in many cases it's better for you to make the down payment yourself. You're going to avoid fees. You're going to avoid longer escrow periods or longer closings, and you're just going to have overall less stress. But they are available, and you definitely should utilize them if you need them. Down payment assistance programs is not a silver bullet. It doesn't fix all the problems, right? So it's not going to magically make you make $500,000 a year. Like there are normal income restraints. You must qualify to purchase the property. You must qualify for the loan, and it's not going to, magically solve our real issues. There are way more programs available than what I'm even mentioning here. It would take us hours to get through this, to go through all of the programs available. So that's why I encourage you to schedule a call with Caroline and myself so that we can determine which ones are actually the best for you. So schedule a call with us, and thank you. Thanks for being on the call.
No, that was awesome. I am going to encourage you guys to, again, figure out how to ask questions. The platform allows for that. Actually, we already have a question. I was going to ask a couple as well, but let's go ahead with Nitais. Can you see that, Chandler, or shall I read it? I'll read it out loud, actually, guys. So assuming the same income, etc., what difference in rates are you seeing today for a credit score of, let's say, 700 versus 850?
Okay, it's a great question.
Excellent question.
Yeah, on down payment assistance programs, the California options, they only offer one rate. So the Dream for All program and the Cal HFA standard down payment assistance programs, you will get the same rate with a 700 credit score or perfect credit at 850. Now, when we're looking at the Rise options, the ones we talked about later in the presentation, those are affected by interest rates. However, given that those ones specifically are FHA only, FHA is not sensitive to interest rate. So you could have a 700 credit score and you would also get the same rate as someone with an 800 credit score. Now, with conventional down payment assistance and conventional loans, those kinds of loans are heavily affected by the interest rate. So what we would see for a conventional loan with someone with a 700 credit score versus someone with like perfect credit, I would say rates, generally speaking, for perfect credit score borrowers are around the low 6s and high 5s, more towards the low 6s now because rates have ticked up over the past couple days. With less than ideal credit, I would really highly suggest looking at the FHA loans so that you can get the benefit of the lowest possible rate, even without perfect credit. That's going to be probably in the mid 6s, even in the upper 6s, depending on the scenario. So if you're buying a condo with a 700 credit score, I'm going to see rates probably closer to 6.625, 6.75.
Again, excellent question. And
Mhm.
Nitai says, thank you. We have another question from Carmina. Does the Dream for All program take into account both incomes in a two-income household? Is it possible to apply and report only one income?
Good question again. So the answer is the only income that would be analyzed by the program is the income that I'm going to submit on your behalf. So if there is two incomes in the household, we can be creative and only include one of the partners' incomes. We can try to manipulate the income for both partners to see if we can get it down within the limits, but it's very possible to just include one person. And if both partners are making relatively the same amount of money, then something that could be smart to do is have two applications for the Dream for All program. You can have one person apply and another person apply, so you can kind of double dip in that sense.
Again, excellent question. Do we have any more? Now is a good time. Otherwise, I have one or two. So not sure if anybody else is wondering, but is it possible to combine programs?
None of the programs we talked about here can be combined with one another because all of them function in the same way. You're getting one loan with a small down payment assistance second loan. Now there are also, which I am not claiming to be the expert on, but there are specific programs available in different areas. Like for example, Long Beach, I know that there is a grant available in the city of Long Beach where you could layer that on top of these programs that we just talked about. I'm not personally certified for the Long Beach City grant. There are lenders available for that, but that could be done.
Great. I also have another question. You know, I work with a number of veterans and active service members. And then, of course, I'm also aware of different programs potentially for like educators or first responders. Like, can you share some words on that?
Yeah, so as far as veterans go and VA loans specifically, the VA loan is in and of itself a down payment assistance program because you don't ever need to make a down payment on a VA loan. So you wouldn't necessarily need down payment assistance for VA loans themselves because you don't need to do a down payment at all. You could layer a VA loan with a grant, like I was mentioning before, but also back into the presentation, it is very true that there are down payment assistance programs are not perfect. And in many cases, if you can make a down payment yourself, you're better off doing it that way because you're going to avoid fees and you're going to avoid stress and longer closing times. So given the fact that all of these down payment assistance programs are loans, right? You're getting a first loan and you're getting a second repayable loan. It's generally better for VA to just do zero down and just do a VA loan. With first responders, medical professionals, teachers, there are no really specific programs that I know of that only target those kinds of people or have benefits to those kinds of people. There are, of course, lenders out there that will give parts of their commission back towards first responders, which I also do, but there is no specific program to my knowledge. There used to be programs that you could only apply if you were a first responder or medical professional. I don't have access to those programs anymore. All they were exactly what I just laid out already on this presentation, but it was an extra requirement that you must be one of those people to even qualify for it. There wasn't any extra benefit to it.
Mm-hmm. Okay. Oh, we have another question from Sherlinda. Being a first-time buyer, I understand your spendage is very vital once applied. Do you provide tools that can help that?
I would say, so if I'm understanding this correctly, once you've applied, your credit score remains very relevant, and working on your credit, working on your budget, your monthly budget is definitely something that I can help advise you on. I have tools at my disposal to be able to work on credit scores over time. I run simulations to say, hey, if you pay down this credit card by this much, here's what your credit should turn into over time. And then also, like, I'm well versed in generally good financial practices, so I can help you with advice on that end as well.
Sure. I have a couple of questions. Not sure if now is the time to discuss them, to be honest, but one thing might be, of general curiosity, like, how early in the process do you recommend people becoming acquainted, number one, with their credit situation, their credit score, as well as what are some of, like, what is your, some insight or based on your experience, like, the advantage of knowing about that sooner and the ways that you can vastly improve your credit, like in a fairly short period of time?
Yeah. So, I mean, the answer is pretty clear. It's as soon as possible. It's as soon as you physically can do it, because it costs you nothing to talk to a lender. It just takes some of your time. And after that call with the lender, you're going to have way more information than you did prior to the call. So getting in touch with the lender early, way earlier than you even think. There's no too early time. You're going to have a call with someone who's going to look at your financial scenario and help you uncover potential roadblocks. You may have no roadblocks. You may have a perfect application. You may have certain things that need to be worked on. So it's important to know what those are sooner rather than staying in the dark and just kind of hoping that it works out. Now, to go on to your question about credit, credit is not something that moves very quickly up. You can very quickly tarnish your credit reputation, but it's kind of hard to get it to go up quickly. So I would say, like, if you're working on your credit or you're even having slight concerns about your credit, I can do a soft credit check so it doesn't impact your credit score. And we can take a look at what's there so that you can start towards working on paying down balances or working on removing a collection or whatever. I mean, there's a million different things that could be on that report that we want to look at so that you can work on them over time.
Yeah, and basically the takeaway being that knowledge can only help you along this path, right? So whether it is, becoming aware of a delinquency or collections that's on your report, that actually, once you remove that, to my understanding, can improve the score fairly, not rapidly, but like drastically. So
if you can remove a collection, that's going to impact your credit score in a huge way positively. But they don't get removed overnight. I mean, sometimes they can't be removed at all. But the process to remove that kind of thing can take months. So it's important that if home buying is on your radar, you want to get that process started.
All right. Well, I would encourage you to ask questions if you have any left, or we will start to wrap up. Any questions? Okay. Well, I hope you got something out of this. Oh, I see some hands. Oh, that's nice. Yeah, this was a brief one, but, really, hopefully this just kind of, sort of opened your mind to not only the existence of some really great programs that are out there, but the importance of connecting with professionals as early on in the process as possible, not because there's any inherent pressure, but because it just allows you to see the path forward with accurate vision and accurate information. So I hope you guys got something out of that. I see. Thank you so much for your time. Thank you, Sherlinda. I appreciate that. We have your information. You have ours as well, actually. So if you have any questions moving forward, please don't hesitate to reach out. That also goes for, if you know anybody who has any questions like this about maybe first-time home buying. Doesn't have to be first time either, but please feel free to reach out to one or both of us. We would be happy to answer your questions. If any of you specifically are thinking about pursuing a Dream for All application that is, once again, time sensitive, in that case, please reach out to me and I will sort of help you get that started. Point you in the right direction for that. And Chandler is seriously my favorite lender. I've worked with many. He is a standout, truly. So we're lucky to have had you, Chandler. Thank you so much for putting this presentation or for putting the presentation together. And yeah, and I'm really grateful that you all got to spend some part of the evening with us today. All right. Thank you so much, everybody. Have a good night.